There's a peculiar question that comes up every time I meet someone new to investing, and it always sounds the same. They lean in close, eyes bright with expectation, and they ask me when the next crash is coming, or when the market will hit its peak, or which sector is about to explode. And every single time I give them the same answer, though I can see the disappointment wash over their faces when I do. I tell them I don't know. I tell them I've never known. And more importantly, I tell them that not knowing has never once stopped me from doing well in the markets over the course of more than 6 decades. Now, that answer frustrates people. They think I'm being coy or holding back some secret, but the truth is far simpler and far more important than any prediction I could offer. The real secret, if you want to call it that, is that the best investors I ever known, the ones who've built substantial wealth and held on to it through every kind of market weather you can imagine, have never been the ones trying to predict where things are headed next week or next month. They've been the ones who understood something more fundamental about how risk actually works and how human beings actually behave when money is on the line. See, most people think risk is something that exists out there in the market. They think it's hiding in stock prices or interest rates or economic reports. They think if they could just read the signals correctly, just predict the next move accurately enough, they could dance around the dangerous spots and land safely on the profitable ones. But that's not where risk lives. Not really. Risk lives inside us. It lives in the decisions we make when we're scared. It lives in the overconfidence we feel when things have gone well for a while. It lives in our impatience, our need for action, our discomfort with doing nothing when the world seems to be moving fast around us. I learned this lesson slowly, not through some moment of sudden insight, but through watching people make the same mistakes over and over again across decades. I watched smart people, accomplished people, people with advanced degrees and impressive careers take their hard-earned money and hand it over to whatever seemed exciting at the moment. And I watched many of those same people lose substantial sums, not because the market betrayed them, but because they betrayed themselves. They sold when they should have held. They chased returns that had already happened. They convinced themselves that this time was different, that they had figured something out that everyone else had missed. Here's what I came to understand. The market itself is actually fairly predictable in one important way, though not in the way most people think. You can't predict what it will do tomorrow or next month. But you can predict with reasonable certainty what it will do over very long periods. It will go up over decades. It will experience setbacks, some severe. It will reward patience and punish impatience. It will transfer wealth from the anxious to the calm. These aren't predictions so much as observations of human nature and economic reality repeated across more than a century of market history. But knowing this doesn't help you if you can't control your own behavior. And that's where most people stumble. They know intellectually that they should buy low and sell high, but emotionally they find themselves doing the opposite. They know they should ignore short-term noise, but they can't resist checking their portfolio every single day, sometimes multiple times a day, letting each small movement affect their mood and their judgment. They know that diversification makes sense, but they can't resist putting too much money into whatever has been working lately because it feels safe and smart, even though it's often neither. Let me tell you about something I observed many years ago that has stuck with me ever since. There was a man I knew, a successful doctor, very intelligent, very disciplined in his profession. He had built up a decent portfolio over the years, nothing fancy, just steady accumulation. Then came one of those market corrections we get from time to time. Nothing catastrophic, just a normal pullback of maybe 15 or 20% over a few months. And this man, who in his medical practice would never dream of changing a diagnosis or treatment plan based on a few days of symptoms, completely panicked. He sold everything, every single holding. He told himself he would get back in when things settled down, when the picture became clearer. But of course, things never became clear. The market recovered, as it always has eventually, and he watched from the sidelines. He kept waiting for the right moment, the obvious moment to buy back in, but that moment never arrived because such moments only look obvious in hindsight. A year later, the market was substantially higher, and he had missed the entire recovery. He had turned a temporary paper loss into a permanent real one, not because the market failed him, but because he failed to understand his own psychology. Now, what he didn't realize, what most people don't realize, is that the real risk wasn't in the market declining 15%. Markets decline. That's what they do. That's part of the price you pay for the long-term returns they offer. The real risk was in his own predictable reaction to that decline. The real risk was that he would let fear override reason. The real risk was that he didn't have a framework in place to prevent himself from making exactly the mistake he ended up making. This is what I mean when I say that smart investors focus on controlling what they can control. They can't control whether the market goes up or down tomorrow. They can't control what some CEO says in an earnings call or what the Federal Reserve decides at its next meeting or whether there's going to be a crisis in some part of the world that sends stocks tumbling. All of that is noise, and it's completely outside their control. But they can control how they react to those things. They can control whether they have a plan in place before emotions run high. They can control whether their portfolio is structured in a way that lets them sleep at night regardless of what the market does. There's a framework that the best investors use, though they might not call it that. It's not complicated. In fact, it's almost disappointingly simple. But simple doesn't mean easy, especially when your emotions are involved. This framework starts with understanding that your worst enemy in investing is your own tendency to do something when doing nothing would be wiser. It continues with structuring your portfolio so that no single position, no matter how promising it seems, can devastate you if you're wrong. And it culminates in developing the mental habits that allow you to watch your portfolio decline in value, sometimes significantly, without hitting the panic button. Let me walk you through how this works in practice, because I think the details matter. Imagine you have $100,000 to invest. Now, most people immediately start thinking about what to buy. They want action. They want to put that money to work. But the smart investor starts by thinking about a different question entirely. They ask themselves what would happen to their life, to their plans, to their psychological state if this 100,000 turned into 50,000 over the next year. Could they handle that emotionally? Would they panic? Would it force them to change their strategy? If the answer is no, if a 50% decline would be devastating either financially or emotionally, then the solution isn't to try to predict whether such a decline is coming. The solution is to structure things so that such a decline either can't happen or won't matter much. Maybe that means not putting all the money into stocks. Maybe it means spreading it across many different investments rather than concentrating it in a few. Maybe it means keeping some portion in something boring and safe that won't keep you up at night. The exact approach matters less than the principle, which is that you're deliberately choosing a structure that you can live with in bad times, even if it means giving up some potential gains in good times. This is the rarely discussed principle I mentioned earlier, the one that connects psychology and portfolio resilience in a way most people miss. It's what I call defensive positioning, though that phrase doesn't quite capture its full meaning. It's not about being pessimistic or expecting disaster. It's about recognizing that the future is uncertain, that bad things will happen at some point, and that the best protection against those bad things isn't trying to predict them, but rather building a portfolio and a mindset that can withstand them without forcing you to make terrible decisions in moments of stress. Here's why this matters so much. The math of losses works against you in a way that most people don't fully appreciate. If you lose 50% of your money, you need to make 100% on what remains just to get back to even. That's not a symmetric relationship. A 50% loss requires a 100% gain to recover. But a 20% loss only requires a 25% gain. And a 10% loss only requires an 11% gain. The deeper the hole you dig, the harder it becomes to climb out. So the real work of smart investing isn't maximizing your returns in good times. It's minimizing the depth of the holes you fall into during bad times, because those holes are what truly damage long-term wealth accumulation. Now, most people approach this exactly backwards. When times are good and everything they own is going up, they get more aggressive. They tell themselves they've figured things out. They add more risk to their portfolio because it feels safe to do so. Everything they've bought lately has worked after all. Why not double down? Then when times turn difficult and their portfolio starts declining, they get defensive. They sell, they hide in cash, they wait for clarity. But this is precisely the opposite of what works. You should be most defensive when times are good, when prices are high, when everyone around you is confident. And you should be most willing to hold steady or even add to positions when times are bad, when prices are low, when everyone around you is fearful. But doing this requires something that doesn't come naturally to most people. It requires separating your emotions from your investment decisions. It requires having rules in place that you follow even when, especially when, following them feels uncomfortable. It requires accepting that you will sometimes look foolish to others who are caught up in whatever trend is dominating the moment. I think back to the late 1990s, during that incredible technology bubble. Everyone around me seemed to be making fortunes in internet stocks, companies with no profits, often no revenue, just big ideas and bigger stock prices. And people thought I was missing out. They thought I was too old, too stuck in my ways, unable to understand this new economy that was unfolding. The truth is, I understood it perfectly well. I understood that when stocks trade at 100 times sales, not earnings, but sales, something has gone very wrong in people's thinking. I understood that eventually reality would reassert itself, as it always does, but I didn't know when. I couldn't have told you whether the bubble would pop in 6 months or 2 years. What I could tell you was that I wasn't going to risk permanent loss of capital chasing something I didn't understand at prices that made no sense. And when the bubble did eventually burst, when trillions of dollars of wealth evaporated, I didn't feel vindicated or smart. I felt sad for all the people who had convinced themselves that this time really was different, that the old rules didn't apply anymore, because the rules always apply. Human nature doesn't change. Basic economics doesn't change. The tendency for crowds to get carried away in one direction or another doesn't change. What changes is the story people tell themselves to justify doing what they want to do anyway, which is usually whatever feels good and seems to be working right now. This brings me to the daily habits and routines that actually matter in investing, though they're not what most people focus on. The habits that matter aren't about checking stock prices or reading market commentary or staying on top of the latest news. The habits that matter are about discipline and patience and emotional control. They're about having a routine that prevents you from acting impulsively. They're about measuring your success over years and decades rather than weeks and months. They're about being comfortable doing nothing for long periods of time when nothing is the right thing to do. I've always found it interesting that the best investors I know tend to be people who have other things going on in their lives. They have businesses to run or families to care for or hobbies they're passionate about. They're not sitting around all day obsessing over their portfolios. In fact, their relative inattention to daily market movements is part of what makes them successful. They're not tempted to trade frequently. They're not disturbed by normal volatility. They make thoughtful decisions occasionally and then let time do its work. There's enormous power in this approach that compounds in ways that aren't immediately visible. Every time you resist the urge to make a change, every time you hold a good investment through a temporary decline, every time you ignore market noise and stick to your principles, you're making a small deposit in a psychological account that grows over time. You're building the mental muscle that allows you to do the right thing even when it's uncomfortable. You're training yourself to separate signal from noise, substance from speculation, real opportunity from temporary excitement. And the beautiful thing is that this approach doesn't require any special talent or insight. You don't need to be smarter than other people. You don't need access to information they don't have. You don't need to predict anything. You just need to understand a few basic principles about how businesses work, how markets work, and most importantly, how you work. You need to know your own weaknesses and build a system that protects you from them. Let me be specific about some of the mistakes I've watched people make over the years, not to criticize them, but because there are lessons in their experiences that we can all learn from. I've watched people sell wonderful businesses at reasonable prices because they got nervous about some headline or economic report. Years later, those businesses were worth many times what they sold for, and the headline that seemed so important at the time was completely forgotten. I've watched people concentrate their entire portfolio in their employer's stock because it seemed like the safe choice, the one they understood best, only to lose everything when that company ran into trouble. I've watched people chase performance, moving money into whatever sector or strategy had done well recently, always arriving just in time to experience the inevitable disappointment when mean reversion took hold. In each case, the mistake wasn't about a lack of information or intelligence. It was about letting emotion override judgment, about seeking action when patience was called for, about mistaking recent trends for eternal truths. It was about not having a framework in place to protect them from their own very human tendencies. The principle I want you to take away from this, the one that ties everything together, is that protecting yourself from large losses is more important than reaching for large gains. That might sound defensive or unadventurous, but it's actually the most aggressive wealth building strategy there is over long time periods, because avoiding big mistakes means you get to keep playing the game. It means you're still around to benefit when opportunities present themselves. It means you're not forced to rebuild from a devastating loss while the rest of the market moves forward. Think about it this way. If you can generate steady, reasonable returns year after year and avoid the catastrophic losses that set people back years or decades, the compounding effect of that consistency is extraordinary. A 15% annual return that you actually achieve and keep is worth far more than a theoretical 25% return that gets interrupted by a massive loss that cuts your portfolio in half. The smooth upward path beats the volatile, jagged one every single time when you look at endpoints, even if the volatile path has higher highs. This is why the best investment advice I can give anyone is not about what to buy or when to buy it. It's about developing the temperament and discipline to do the right thing consistently over very long periods of time. It's about building a portfolio you can live with in bad times. It's about having rules that prevent you from being your own worst enemy. It's about understanding that the market's job is to separate you from your money by exploiting your emotions, and your job is not to let it. I realize this isn't the exciting answer people want when they ask about investing. They want tips and predictions and secret strategies. They want to believe there's some formula or approach that will let them beat everyone else without much effort. But after spending most of my adult life studying markets and human behavior, I can tell you with complete confidence that there's no such thing. What there is instead is the simple but difficult work of controlling yourself, being patient, staying rational when others aren't, and letting time turn small advantages into large ones through the magic of compounding. The really beautiful part about this approach is that it gets easier over time, not harder. Once you've lived through a few market cycles without panicking, the next one bothers you less. Once you've watched good businesses weather temporary storms and come out stronger, you develop confidence in that process. Once you've seen the power of patience and discipline in your own results, you become more committed to those principles. Experience is the best teacher as long as you're learning the right lessons from it. So if there's one thing I hope you remember from everything I've said here, it's this. The markets will always be uncertain. There will always be something to worry about. There will always be people predicting disaster or promising easy profits. None of that matters nearly as much as your own behavior, your ability to control your emotions, to stick to sound principles, to avoid major mistakes, and to let time work in your favor through patient, disciplined investing. That's what determines your success, not your ability to predict the unpredictable, not your access to special information, not your intelligence or education. The smart investors, the ones who build real wealth and keep it, are the ones who figured this out. They're the ones who sleep well at night because they know their portfolio is structured sensibly and their own behavior is under control. They're the ones who can watch the market decline without feeling compelled to do something about it. They're the ones who understand that investing is ultimately a game of managing yourself, not predicting markets. And that, more than any prediction or tip or strategy I could offer, is the real secret to reducing risk and building wealth over a lifetime. It's not glamorous. It doesn't make for exciting stories, but it works year after year, decade after decade, as surely as the sun rises. And in the end, that's all that really matters.